In 21 days, the S&P 500 dropped 9.7%. In 4 days, it recovered 3.8%. Should investors be concerned? We'll cover this and more in Harmony Asset Management's thoughts and comments. I'm Natalie Crandall, and I'm here with Managing Director Alan Rosenfield of Harmony Asset Management. Alan, there have been some brutal moves in the market recently. Can we dive into what that's all been about?
There are a couple of things that have been going on. First is earnings, Q3 earnings, and then projections for fourth quarter in 2019. Earnings for the third quarter have been pretty good, but there have been more misses than we were expecting. The second thing is a number of companies have now announced that they're having to raise prices. At the same time, there's starting to be some guidance that's being lowered for fourth quarter and next year. It's not a large amount, but they have pulled them in some. The second issue is a speech that Jeremy Powell, the chairman of the Fed, gave on October 3rd. And in this, he said that we're well below neutral levels on interest rates. And that meant he could raise them a lot further. And we're bringing up a chart now, and what it's showing is that the day he spoke, interest rates all of a sudden started spiking and the stock market started dropping because he was getting everybody scared. The reason he's getting scared is, I think, the important issue here, because what he's trying to telegraph is that he needs rates up. Why? The reason why, I think, is because he's worried about trade wars. If we get a trade war, we're going to get inflation. We're seeing more companies report that they're raising prices. I just mentioned that. That's higher inflation. Wages are higher than they've been in a while. They've been growing faster than they've been in a while. So all of a sudden, if we get inflation moving up, he has to raise rates. But if we get a recession, he has to move rates down. But if you get inflation and that's what causes the recession, he's got nowhere to go. So he is trying to force interest rates up, I believe, to kill the interest rate move before it turns into a recession.
So you mentioned that revenue and earnings expectations have been reduced for next year. Why is that?
So the first issue on analysts' minds is a trade war. Trade wars typically will lead to inflation. And if the Fed is behind the curve, it means they'll have to raise interest rates much faster than everybody in the markets expected. This late in the game, that's going to make the stock markets very worried. The second question that has analysts concerned is tied to the trade war, and that's a recession. The economy's long in the tooth. The economy looks good right now, but we're starting to question whether we are at peak earnings. You're getting a number of companies that have started to miss, and it's still relatively small, but it's growing. But you're seeing a lot more companies that are raising prices. If you end up with a recession because all of a sudden there's too much inflation and people stop spending, this will drag down the stock market.
Outside of economics, politics may have an impact on the market. Do you think the upcoming midterm elections will impact the market?
There's an interesting study that James Stack, and in it he actually studied midterms elections going back a number of years and found that by and large they don't have an impact. The interesting thing in this case is you might see some economic impact potentially. If the House is taken over by the Democrats, you might see a change in some economic policies or stopping of some that will simply cause further headwinds.
One last question for you. What is your outlook based on what we have discussed thus far?
So the first thing that we're watching for is headwinds. Earnings had a lot of tailwinds this last year. You had tax cuts, you had a growing economy, you had a higher unemployment. We've had that now for a year. So this next year it's going to have much tougher comparisons, and you're starting to get more inflation now as well. The second part of our outlook is really a strategy, and it's defensive in nature, because we think we're very late in both the economic and market cycle, and because we're seeing more risks coming into play. we want to be more defensive. Now, this does not mean that we're just running to cash, but what it does mean is that we're actually increasing some of our hedges and decreasing some of our asset allocations. The reason is that now, this late in the cycle, it'll be much more important to retain the gains you've made in the last 10 years than it will be to just get the last few percentage points.
This wraps up our latest edition of Thoughts and Comments for Harmony Asset Management. We hope you found this helpful. Please call or email us with any questions, and thank you for listening.